Hi, in this question, we are looking for a contractionary policy. The key part, whenever you see a question like this, first thing is to figure out, are we looking for a monetary policy or a fiscal policy? As you can see in here, there is Fed in here. This is not the federal government, this is Federal Reserve Bank. So, we are looking for a monetary policy. And it's asking for a contractionary policy. We are looking for something to contract aggregate demand. So how the Fed can contract demand, what they need to do, they need to make credit expensive for the bank to lend people, make credit expensive and make credit tight. The way they can do is to make a high interest rate. So we are looking for a reason or a tool in here that is going to squeeze the money market, limit the credit availability, and make it expensive for people to go and lend money from a bank and make spending. That is one thing we need to know. We are looking for a contractionary monetary policy, and we can look at the answer choices in here. Beginning from the first one, lowering reserve requirement. If you lower reserve requirement, you are going to increase money multiplier. So it's going to increase the money creation capacity of the banking system. This is expansionary in nature, expansionary monetary policy. But this is not a correct answer. Lowering reserve requirement will make credit cheap, as banks can lend more money, and there is going to be too much credit in the market. It's going to lower the interest rate. There will be more people willing to get a loan, and this is not contractionary, this is expansionary. Lowering discount rate. As you know, discount rate is the rate Federal Reserve is charging to the bank to borrow from them. So when they do that, they make credit cheap for banks, so they can borrow from the Fed at a cheap rate and lend more money. So this is expansionary monetary policy in nature. And looking at the fourth one, an open market operations in the form of purchasing T-bills. Again, this is from the perspective of the central bank. If they are buying T-bills from the bank, they inject money to the bank, so bank reserves will get up, because Fed is going to pay to the banks, because in return they're getting treasury bills or government bonds. So there is going to be an increase in bank reserves, increase in excess reserve, and it is going to be expansionary in nature. It's a expansion monetary policy. So the best answer will be this one, open market sale. This is a contractionary monetary policy. Why? Because when Fed is selling T-bills to the bank, Fed sells bonds to banks. In return, get paid. As a result, in cash, get paid in cash. In return, it is going to lower bank reserves. Again, when we are talking about bank reserves, this is the reserves at the depository institutions, not at the Fed. There is nothing such a Fed reserve. We are always talking about the depository institutions. Bank reserves will go down. As a result, it is going to lower the excess reserves. It's going to lower the lending capacity of the banking system. There will be less money to lend out, which is going to contract money supply. And we can see as a result, it is going to shift the money supply curve to the left and raise the interest rate. So that's what's going to happen in the money market, thinking this is our money supply initially, if this is our money demand, and if this is our original interest rate. When there is a open market sale, this is a monetary policy conducted by the Federal Reserve Bank, and it's a contractionary monetary policy. It is going to shift the money supply curve to the left, raise the interest rate, and that is going to be the ending result. There will be less money in the economy. This is the quantity of money demanded and supplied. So that is pretty much the summary of this question. We can look at it and see, okay, if we are looking for a contractionary monetary policy, whether we are looking for an open market sale or an increase in reserve requirement or an increase in discount rate, okay, the best answer will be C.